Welcome to the Conversations with a CPA podcast. Today we're going to be discussing itemized deductions. Is it even worth filing itemized deductions? We're going to go over your medical expenses. What can you write off? How is it limited? We're going to talk more about the property tax deductions and how that's limited and capped and how you can get around that, though. We're going to give you some nice little tips about that. And then we're going to discuss your charitable contributions. A lot of people try to write off donations and they're not doing it in the right way. And if you're audited, it can be bad news for you. So let's get right into it.
Let's talk about money. When it comes to taxes, ain't nothing funny. Hey, let's talk about the choices that we make in our lives. Do I save, invest, pay my taxes? What's right? Let's find a solution that will make all our financial troubles go away. Welcome to the podcast, Conversations with a CPA. Conversations with a CPA.
So again, we're talking about the itemized deductions. Here is the Schedule A form, and you usually use this form if you are going to be writing off medical deductions, property taxes, mortgage interest, charitable contributions, and maybe some other small deductions. So let's get right into understanding what these deductions are. What can you write off as a taxpayer? We're going to be giving you some tips on what you need to consider when you're writing off these deductions as well. So in the first section, as we look at the Schedule A form, the first section is medical and dental expenses. So what can you generally write off for medical and dental expenses? You can write off your health insurance, and you can also deduct unreimbursed expenses that you incurred, like doctor fees, if you had to pay co-pays when you went to the doctor, you went to the dentist, and you had a deductible or a portion of the fees that you were paying for cleaning or some other surgery. Um, if you have to buy prescriptions like insulin and other prescriptions that your doctor may prescribe depending on your health situation. If you had to be confined to a nursing home and you're primarily there for medical care, you are able to deduct the meals and lodging. So when we look at the all that you can deduct, you would include that on line 1 that you see. But you have to keep in mind that the medical deductions are limited to 7.5% of your income, of your AGI, of your adjusted gross income. So that means that if your adjusted gross income is $75,000, your medical expenses are going to be limited to $5,625, whereas they're going to take away, you would have to have medical expenses higher than $5,625 to make a difference in your return. Just like if you had earned $125,000 in adjusted gross income, when that 7.5% income limit kicks in, your medical deductions will have to be over $9,375 in order to be deductible. So when I'm working with a lot of clients personally, I see it where it is very difficult to get over the 7.5% limitation that is there. And that is why most of the time individuals will not be able to really benefit from this deduction. Moving on to the property taxes. So you can deduct the state income taxes that you pay that get withheld from your check. If you live in high income tax states like California or New York, this can be a high amount. You can also deduct your property taxes that you pay on your property. Now, if you live in the suburb of Chicago, for instance, you may easily see property taxes upward of over $10,000 easy. If you live in the city of Chicago, you might see somewhere between $4,000 or $5,000 in taxes, depending on where you live. So this amount can range greatly as well. You are capped, though. If you look at line E, you are capped at $10,000 if you're married, filing joint, or single, and $5,000 of a deduction for taxes if you are married, filing separate. What does this mean? This means that most individuals end up with a situation where they have paid over and above $20,000, $30,000 in total taxes, and they can only get the benefit of $10,000 of a write off if they're single or married filing joint. And again, you see in another example of where you're penalized, so to speak, if you're married filing separate, where you only get a limitation of taxes to $5,000. So it's a big difference between married filing joint, married filing separate. Look at our episode that we talk about that in more depth as far as the pros and cons of married filing separate versus filing as married filing joint. But to get back to the taxes, you can see that between the two sections already, we're looking at medical and taxes. You're limited to $10,000 of property taxes, and then you have 7.5% of a limit on your medical deductions. Now, one of the things I want to say about the property taxes before we leave this section and go on to talk about charity contributions, I want to point out that one good way, because this limit is there, the $10,000 limit on the taxes that you can deduct as an itemized deductions, sometimes it's so great that I often look to see if the client uh, runs a business, where if you're running a business out of your home, then we can shift over those property taxes and use it as a business expense. So there are ways that, depending on how you're using your property, you may be able to get past that limit based on what you're doing with your home as far as a business, and be able to deduct more than the $10,000 limit. So let's talk about charity. This is an area where I get lots of spreadsheets that show that a lot was given away as far as clothes and other household items. The IRS, let me tell you, the IRS has seen where there has been write-offs of about $9 billion by the taxpayers wanting to get write-offs for giving old clothes and things to charity. And so they really provide this section in order for you to get the benefit of a deduction. They have written some really tough rules and placed them in place so that if you don't follow those rules, you will not get the benefit of deducting your charitable contributions. So let's look at this. The gifts, any gifts that you make of $250 or more, you have to have some type of substantiation for that deduction. So you need to have a canceled check, a credit card statement or receipt, something, even if it's less than $250, you need to have some type of substantiation. If you've given something of value that was not cash, and you've given away a dresser or furniture piece or something like that, you still need, if it's not worth $250, then you still need a name, an address of the charity, the date, and the description of the property that you gave away. Now, if you give anything of $250 or more, then you need to have a written, contemporaneous written acknowledgement. They call it a CWA. It's a written letter that pretty much the organization will give to you that will state whether or not you have received anything in return, because you can't write off the whole value if you did receive something of value in return for your donation. If you have given away a car, a boat, or plane, you need a form, 1098C, that will pretty much outline what the value of that item was, of that car, that plane, or that boat that you gave away, once the charity sells it. So, another piece of information that I think is important is that the clothing that you give, and any items that you give, needs to be in good, usable condition. Now, true story, my husband, bless his heart, we had a flood in our home, and some things were damaged in our home, and we had some travel bags that got damaged, and by this time they're damaged, they're molded because they were wet with sewer water, and they weren't in good condition. And he's like, well, someone could use these. And I'm like, no, we can't even get a tax benefit because it's not in good used condition. So just throw them in the garbage. So some of the stuff you got to decide if it's something that should just be thrown out, or if you do give it away, make sure it's in good condition. Make sure you have written acknowledgement. And here's a little tip: in order to get over the hump, if you give a donation to a place where an organization that is not willing to give you that special contemporaneous written acknowledgement, then what you can do is break up your donation and make sure that what you're giving is less than the $250 amount. So then we would just list on your return on a special form, we would list all the days that you gave your donations, who you gave it to, and show that they were only worth $200 or $225. That way you can get more value for your donations. Okay. Now, anything you want to write off that's more than $5,000, you need an appraisal. So you can't get willy nilly with it. Okay. But you want to make sure that you have your written documentation. Okay. But if you give away stock or something like that, then it's easy to prove the value and you don't need an appraisal if your donation is worth more than $5,000. So there is written donations, but the IRS knows that most people don't give to charity to that extent. So they are really looking heavily at this section. So don't play around with it. Okay. Make sure you have your documentation in order. So, as a recap, as we close out this episode of Conversations with a CPA, we have talked about the itemized deductions. We have explained to you what you can write off as far as medical and dental expenses, and hopefully saved you some time in not gathering up receipts if you're not going to be over that 7.5 of your adjusted gross income limit. So, if you know your medical deductions are not going to be over 7.5% of your income, then which is just a good rule of thumb. Just take 7.5% of your gross wages and see what that is. And if your medical expenses don't touch that amount, don't even worry about it. Okay. Don't save yourself the trouble of gathering up receipts and other documentation. We've talked about the property taxes and how you have that $10,000 limit if you're married, filing joint, or single. And if you are married, filing separate, your property tax and state income tax limit drops down to $5,000. So another penalty, if you will, for married filing separate. And so one of the things that we told you that you could do is if you're using your home for any type of business purposes, you might be able to shift some of those property taxes over to your business side as a deduction. So that way you can get more bang for your buck and be able to write off and get more benefit of those taxes than just being limited to that $10,000 mark. And then finally, we discussed the gifts to charity. Now, there are other things that you can deduct on the itemized deductions, but those are the high level areas that we see more commonly being used. You can always feel free to talk to your tax professional and see if they believe that you can qualify for some of the other deductions. But generally, if you can't get over the itemized deduction hump, then you're going to get the standard. And now at this time, the standard deduction for single individuals is $12,400. It is $24,800 for married filing joint. So honestly, about 90% of the taxpayers really use the standard deduction anyway. Very few people itemize because of the limits, the high limits for the standard deduction, as well as all of the phase out and limitations that you have for your itemized deductions.